For joining. So today we are going to talk about straddles and strangles, stock option trading strategies. So feel free to ask questions. I know you guys normally don't hesitate to ask. So let's plow ahead. So I just wanted to reinforce some of the disclaimers, right? So I think you all know because you are all familiar with options. That is why you are attending this advanced strategy class. But still, I want to highlight that any of these strategies can lose you money, right? It can get you money, but you can also lose money, right? So there is no guarantee, and it's also difficult to, it may be difficult for getting rid of your positions quickly and so on, right? So there is a risk of loss if you don't know what you're doing. So definitely be careful trading in options, and definitely don't sue me if you lose money, right? Okay, so let us talk about straddles and strangles, right? Now, so basically, we have, it is a combination of calls and puts, right? So what is a call option? Can somebody say that? What is meant by call option?
The right to buy at
Yeah,
that
right
price.
to buy a stock or a ETF or something on a fixed date, which is the expiration date or before, at a fixed price, right? So which is the strike price, right? So that is the call, and put is on the other side, right to sell, right? So that is right to buy and right to sell. So basically this is a combination of these two, right? So basically straddle means trade ATM at the money call. At the money means like strike price is equal to the current price, right? So normally you might buy some calls, maybe you can buy in the money calls or out of the money calls, or you can do whatever you want, right? But here in this specific strategy, it talks about at the money calls and puts for the same expiration date, right? So the advantage here is you don't know whether the market is going up or down, right? So you have, like, it gives you a flexibility, right? So it gives you a flexibility irrespective of the direction of the market. So that is why it is sort of a neutral strategy, right? So it is not a bullish strategy or a bearish strategy. It is more of a neutral strategy. And let me let some people in. So it is a neutral strategy. So because it gives you the flexibility to either make money when the stock goes up or make money when the stock goes down, right? So that is the definition of straddle. But of course, there are advantages and disadvantages of this strategy. We will discuss all those things. And strangle is a slightly more like a tuning of straddle, right? So straddle by nature, because you are dealing with ATM calls and ATM puts, it is going to be very expensive, right? Particularly if you are long, right? If you are buying calls and puts at the money, right? It is going to be very expensive. So this strangle, it gives some flexibility of reducing your investment, right? When you are long, by doing out of the money calls and puts for the same expiration date. So it is a slight tweak on straddle. So here it's both are ATM calls and puts. Strangle, you have out of the money calls and puts for the same expiration date. Okay, so let us talk about the long side and the short side, right? So you can be on both sides. So you can be on long side straddle or long strangle or short. All those strategies are possible. When I say long, what does it mean? When you're saying you are long, what does it mean?
Buyer of the option.
Yeah, so buyer of the option, exactly, right? So whereas short means, so
Seller.
you're selling, right? So basically investor is the buyer of put or call option, long, straddle or strangle. And the problem here is because when you're long, you're paying out a lot of money upfront, right? Because you're going to shell out a lot of money upfront by spending the premium, right? So you have to pay for the call premium and you have to pay for the put premium. So it is, you are going to invest a lot of money. So it's a debit transaction, right? To start with, it's a debit transaction. So you are putting the money in, and the only way you can benefit is if the stock moves either up or down, right? You don't care whether it moves up or down, but it has to move drastically more than what you paid, more than what premium you paid, right? So that only then you will benefit, right? So when does that means the volatility is very high, right? Volatility is can be high at the time of, for example, earnings announcements, right? So earnings announcements, you don't know whether their quarter has been good or bad or whatever. Typically you see that the stock moves quite a lot for before earnings after earnings announcement, right? So this way, if you think that this is going to move quite a bit, it is going to beat by a lot or short by a lot, then you can buy a strangle. So that means even if it goes up too much, you benefit. If it comes down too much, you benefit. But if it doesn't move that much, then you lose your money. So let us look at the profit graph, right? So the y-axis is the profit and loss, and the x-axis is the price at expiration. So you bought the ATM calls at the strike price. So immediately you are under loss situation, right? So immediately you are at the bottom of the sort of a V, right? So you lost money at that time, and the only way you can make money is if it moves more than whatever you paid for both calls and put together. We will look at the formula, right? So that means when if you are buying a long strangle, don't think or straddle, right? Don't think that it's an easy way to make money, because you can make money either when it goes up or when it goes down, right? It has to go substantially above the premium that you paid. Only then you make money, right? See, this is the profit curve. It takes off only after satisfying the premium you have paid, right? On either side of the strike price, only then you will start making money. So, but the risk is limited, right? See the bottom of the V, right? So that is fixed. So when you're buying you are investing some money, like you are buying a call option, you are buying a put option, and that is the maximum loss. So whatever premium you have paid, and that is the maximum loss you have. So let us look at the long strangle curve. So here, instead of a V, this is more like a bucket, right? Because you can choose
पता
different.
नहीं क्या मैंने सुना ही नहीं क्या था.
So Bisham, are you talking to us or? Okay. Yeah, Bisham is on mute. Okay, good. So long strangle, right? So you have the A and B, where it gives you that there are two different strike prices, same expiration date, but two different strike prices. That gives you flexibility, right, of reducing your premium, but at the same time it has to go wider, right? It has to go wider to make profit, right? So the probability of profit is higher here, but the so that we will be looking at later. So is it all clear on the long side? We will go in much more into depth on all these things. And let us talk about short strangle and thing, right? So let us say if a particular stock, it doesn't move at all much, right? Or if you think that the market is pretty stable, it is not wildly going up or down, and the volatility is low, and you, we don't care whether volatility is low or high now, but you don't think the volatility is going to increase, right? So the vega, which determines which is the volatility factor, if it doesn't increase, then you benefit, right? So then only then you have to think of like selling calls and puts, right? So when you're selling calls and puts, you immediately make profit. But when the stock moves either too much in the down way or too much up way, then you lose money, right? So that is why there is an unlimited risk here, right? So short straddle, as soon as you sell the call and sell the put options, you make money, right? So that is your maximum profit. And if the market doesn't move at all, or if the particular stock you are selling this doesn't move at all for a whole month, or when you are selling the um, options for, then you benefit, right? So if it doesn't move much, as long as it moves between these 2 points, then you make money, right? Otherwise, you will lose money. And if it goes up too much, like Tesla did, or if it goes down too much, like Enron does, so then you have a huge risk, right? So either way, you have a huge risk because you are a seller on both sides. So this one you can think of using as a neutral income strategy only when you think the market is not going to move or a particular stock is not going to move too much. Any broad questions on this? We will go into more depth on all these things. Okay, so let us jump into first long straddle and long strangles. So let us talk about long straddle, right? So basically buy a call and put at the same strike price and the same expiration date, right? And maximum gain is unlimited, right? So if the stock goes to zero, also you benefit. If the stock goes to goes up a lot, then 10x, then also you benefit. And maximum loss is only the initial premium you paid, initial debit. And break even point, right? There are two break even points, and both are like plus. That is why you have the plus or minus. Strike price, plus call premium plus put premium, right? So the combined premiums. So you have to add all that. That is the both sides. That is the break even point. So the same thing, right? So the maximum profit at the time of when you're buying, maximum loss is at the time of buying. But after that, if the stock moves, then you may be benefited, right? But there is no profit at expiration unless the intrinsic value of either the put or the call. It can be either, right? You don't care. You don't care whether you're making money because the stock is going up or whether you're going down, but it has to be greater than the sum of the premiums because you have laid out a debit, and it has to go higher than that. Only then you will make money. So I should close this. Okay. And the so you have two things here, right? So you have the put payoff, but because you have already paid the premium, your profit will be less than the payoff. So that is why we are showing two lines here. One is how much do you get when you sell the call or put. You cannot obviously sell both, right? So depending on whether the stock has gone up or gone down, you will sell one of them. Other will be out of it will be worthless, right? So but because you have invested money for both put option and both call option, then you have to deduct the premium paid from payoff. That's why the profit is less than the actual payoff. Okay. Any questions on this? Do you guys see any advantage of using long straddle? Any use case?
So do you do this?
I would say the stock is volatile.
Right.
Yeah, just earnings report and stuff like that.
Mm.
Tonight for Google, it would have been good.
Yeah. Right. If you had a straddle on Google, then I think it must have gone up quite a bit today. Right. So
At the option premium,
yeah, but we still have to calculate, right? So
it will be very
okay. Okay. So yeah, that is exactly what it says here, right? So you guys said this, right? Outlook. So only when you have the outlook, the significant price swing in either direction during the life of the option, the faster the move, the better, right? So faster the move, you can make money and get out of the position. And increase in volatility also, right? So you want the volatility to increase. Obviously, when the volatility increase, your option pricing also will increase. So you can gain either by the increase in option price or by the appreciation of the intrinsic value, right? So appreciation of the stock itself. So you have two advantages here. So that is why the Greeks are like this. So delta is neutral. Can somebody except Bala say why delta is neutral or almost zero?
Since you're buying on both the sides, right, it kind of balances each other.
Yeah. So one delta is positive, another is negative, right? So when you add them, it is zero, right? So because so you don't care about the delta as such here because it'll balance each other out. And gamma, right? So gamma, I don't think we have covered in any of our sessions. Gamma is another Greek rate of change of delta, right? Given a $1 change in the underlying, right? So how much? So delta itself, it is like velocity and acceleration, right? So delta is how much the option changes when the underlying stock changes, right? So here rate of change of delta itself, rate of change of delta, how fast it moves, right? So the faster it moves, then you have the chance of getting more money, right? So that is why gamma is plus here. And vega is the volatility index, right? Volatility Greek. Rate of change of the options price given a 1% change in volatility, right? So how much your options price will change given a 1% change in volatility. And that also helps you because, can somebody explain why Vega plus helps your position of long straddle? So basically when Vega increases, right? So your option price is also going up. So you have the chance of, you bought the option, when the option price is going up, it is good for you because you can always close out the position at a profit. And theta is negative, right? Theta everybody knows, right? So because it is the rate of time decay, passage of time. So if you bought like a straddle or a strangle for 1 month, right? So theta is definitely very important, right? So because every day it moves, if the stock is stable, then you are going to option value is going to depreciate. So you will get hit on both sides, right? Because you have bought both a put and you have bought a call. So when the time value deteriorates, then you will have a problem, right? So theta is negative here.
I think what they are talking about, Nari, is the at the time of making the trade,
Yeah,
you're saying gamma and vega will be positive.
right.
That's all. It is just mathematically true. That's all.
All right, right,
I
right.
don't really think they are suggesting that better vega is better, positive vega is better.
Mm-hmm.
Positive vega and positive gamma will be reality at the time of trade. I think that's
Right. Yeah, no, that is true. But even the outlook, I was thinking it works out, right?
Yeah,
If
yeah, that's true.
Yeah. So that's what I was saying. See, Vega is positive at the time of trade, but when we are looking at outlook, increase in volatility, that means increase in Vega also helps you.
Yeah, increase
Yeah,
in
it is
volatility
both.
because you paid less value. If it
Yeah.
is low volatile, you would have paid less value for your premiums
Correct.
of call
Correct.
and put. And if the volatility increases, immediately the thing will go up, even
Yeah.
if the price doesn't change,
Correct. Exactly. Yeah,
and you
that's what I
can
was saying.
sell and make money.
Yeah. Absolutely, you're right. Okay, so just an
So
example here.
isn't it each one of them being positive increases your odds of being out of the negative triangle? The chance of getting out of that negative increases when the vega is positive, or meaning the outlook of the rate of change is positive, and
See,
outlook the
typically,
gamma being positive. So chances of you getting out of the triangle, the negative triangle, is that much higher.
Yeah, if volatility increases, definitely that is the case, right? So if Vega keeps increasing, like Bala said, right? So you have a better chance of getting out of the trade
Right.
at a positive.
without price moving up.
Yeah,
Exactly. That's where I was going.
yeah,
Without even price moving up, just
yeah,
the fact that they feel like it's too volatile increases
yeah,
your chance,
correct.
along with the price itself moving because of the volatility. That's
Yeah,
what I meant to say. Right.
yeah. So this is an example. I think you guys have all understood this. XYZ stock is trading at $100 a share in January, right? So you can buy one February 100 straddle for $10, right? So you buy one February $100 at $5, and buy one February 100 put at $5, right? Because the stock price is currently 100, and you are doing the strike price also at the money. So that is why you have the 100 call and 100 put. And your strategy direction, volatility in either direction will benefit you. So immediately you lose $1,000, right? So 100 times 5 plus 100 times 5. So 500 plus 500, $1,000 debit. But if it moves quite a lot, then you make money, right? But if the maximum loss is just 1,000 debit, you lose all the thing that you paid. So I can exercise either long option, either long option, right? That is the benefit of straddle, right? So instead of just having a call or a put, it gives you advantages in both, chances of it getting in the money. So this is just a little more detail. So I will share the deck and we can understand it. But as Bala said, right? So at the time of trade, right? So if you look at that, so on the right side, you have the delta. 53 minus 53 position has become 0, right? So whereas gamma is $2.30, and then theta is you are going to be negative because it is going to time value minus 15, it becomes minus 30. So it's additive here on the reverse side, and Vega is also benefits you. So that's what Bala was saying. But it can move, right? It can move. Okay, so it's pretty easy to do a straddle in Thinkorswim. So basically, this is a screenshot, right? So you highlight it anywhere, right click and click buy straddle, right? So that's it. So they make it simple for you. You don't have to, even though it is 2 transactions, you can do it in one shot. So straddle, so both are buy, right? So in the green here, +1, -1, and the expiration date, and this is strike price 438. I think I took a screenshot like a couple of weeks back, so it may not be correct. But see the outlay, right? So you have to pay like $24 premium for 1 month. So because it's at the money, it can be pretty expensive. So maximum loss is in this case for a SPY 2,414, right? So that's what it was a few days back. So any questions on the Thinkorswim? Has anybody used this so far?
I used to do straddles and strangles a long time ago.
Mm-hmm.
But these are neutral strategies,
Yeah,
if you think um, before earnings and all you can take, it's a pretty risky strategy. Sometimes if it doesn't move, you can
yes,
lose a lot
absolutely.
of premiums.
And it's an expensive strategy if you are long, right?
Yeah.
Yeah, it is an expensive strategy, but it can pay off. You can get in and get out.
See,
I
the
do
problem
it.
with the strategy, if you were to take 1 month, $24 is the theta. The theta
Yeah,
is going to go away every day. The $24 will become $22, $20. It'll keep going down.
correct.
Every day the value will go down. If the stock doesn't move, the value will go down for you.
Yeah, correct. Yeah, the stock has to move. So you
That's
think
why
that
condor will be better, where
yeah,
you sell something against it and then you try to reduce your investment from $24
correct.
down to $12 or something, and you kind
Yeah,
of do a condor.
yeah. I am going to cover condors and butterflies in the next class.
Yeah.
Not next week, but I think yeah.
So
So
another
yeah,
question, when you said volatility, so every stock that you look in TD, it has a volatility percent, right? 70, 80%. So what's the best practice here? Like how volatile it has to be? Like, do we have any guidance, like 2% a week or something like that?
see the current volatility, right? Ultimately, it doesn't matter, right? But because you want the volatility to increase from the time you bought it, because if the current volatility is itself high, then you're going to be paying a lot of premium anyway, right? So you're going to be paying a premium, and if the volatility is low, you will be paying less premiums.
Yeah, I think that's
So
the
you
key.
you are hoping that the volatility will increase, and then you buy the straddle.
No, no,
Okay, so
no.
let's say,
You buy the straddle or strangle uh, when volatility is low. If the volatility goes up,
Yeah,
even if the position has not moved in any significant way, you can make money just because the volatility has gone up, the
yeah,
premiums will go gone up.
like if you had bought Netflix like 2, 3 days back.
yeah,
Yes, when the volatility goes up. So when the volatility is low on SPY, for example, a straddle will be a good thing because you think the volatility is low because they think the price is stable, but for some reason you think the price is not going to be stable, the price is going to go up or down. Then you buy a straddle. Then when the volatility goes up, you will make money even if the price doesn't move.
yeah, exactly.
These are very
So
difficult strategies, by the way, to make money on. That's my opinion.
Larry, this is Madhu on the previous slide.
Yeah.
So this plus or minus, probably it's about 5%. Is it always the same, or you can choose that? I think the strike price was 438, and
Yeah, so current market price when I took the screenshot was 437.98, right? So 438.
Mm-hmm.
right? And you have the straddle. When we are talking about straddle, the strike price is the same as the current market price. So
Okay.
it's at the money. That is when you buy. So you don't have to. There is no decision here for
Okay.
straddle. What is the strike price and all that? You just click that, and then it automatically populates the current market price, and that's it. When we talk about strangle, you have some flexibility in moving the strike price.
So automatically, when you say straddle at 438,
Yeah.
it will show a range of 413.86 to 462.14.
Where does it show the range?
Break
Oh,
even stock price.
oh yeah. Correct. Because break even is 438 minus 24, right? So minus or
Oh,
plus.
okay.
So 438 minus 24 is 413.
Right.
Right, and then 438 plus 24 is 462,
Oh,
right? That is how you have break even on both sides.
right.
So only if the stock move if SPY moves more than 462, then within 1 month, then you make money. So
Oh,
that is why Bala said, right? This one, it is a temporary strategy for specific things, but it is good to know, right? That is why I'm covering this.
oh,
Right. So, but
So in
it
this
is not. It's
example,
not. Sorry.
go. So what I'm saying in this example, if it's 437, if it went above 462, then how
Yeah.
much money will you make on both the premium and the capital gain?
So then only then if it goes to 470 at the end, right? The intrinsic price will be like $8, right? So you'll make $8 on that. So
You mean $8 you'll make on the premium, you mean, right?
no premium you are paid, right? You are paid $24 already. So 2,400 you are paid already. See that's why it may not be good for ETFs like this, right? See, only when
Yeah.
the stock goes up quite a bit within the next 1 month, only then you will make money. So that is why it is regular ETF. It irons out, right? ETFs don't move as fast as individual stocks. Even though this
Mhm.
example is here an ETF, this strategy is probably more suitable for individual stock, unless there is a huge market crash or something, right? Only then you will benefit in that.
When I was going through the classes, one of the things that they talked about is on the technical side, if you are following the technical chart reading, if that is going to indicate a massive move on the price, either up or
Yeah.
down,
Mm-hmm.
then you can take a straddle because technicals are saying it's going to stock is going to drop or it's going to go out to the breakout. So there are some theories by which if the what do they say, it is the top of the chart is coming down, that is lower highs and higher lows. If lower highs and higher lows are happening and they're going to meet at a point, then it could either shoot up high or shoot down low. That's a technical indicator. So if you
Right.
are following a technical indicator of that, then if you believe that, then you can buy a straddle.
Mm.
So that's why straddle is a very, very tough strategy for.
Correct. For on the long side.
Yeah.
Okay. Let us look at this. So I think we covered this already. Oh yeah. Sorry. This we are moving on to strangle now, right? So we are finished with long straddle. Here the strike price can be different. That is the only difference, right? So the main difference between straddle and strangle is, so here you are buying a higher strike call and a lower strike put. So that way you can reduce your premiums, right? Because at the money options are always expensive, right? So here you are buying a different strike price for both put and calls. Calls are higher and puts are lower. So that way, your premiums will be less, but even then the stock has to move beyond those things, right? So beyond those premiums, only then you'll make money. So it is very similar to straddle, except that the strike prices are different.
And probability of making.
Yeah. So outlook, significant price swing in either direction. The faster it is similar, very similar to straddle, and even the Greeks are very similar. So XYZ stock is trading at 100, buy 195, 105, right? So you are buying a 105 call and a 95 put, and both cost $2, right? So you have spent $400. In the previous example, you paid like $1,000, right? Because it was at the money. Here you are paying only $400, and so so this is the graph, right? So they have given detailed thing when you will start making money. It has to move beyond the market price and whatever premiums you paid. So again, buying strangle is very simple. So again, TD Ameritrade makes everything simple, but here you have more flexibility, right? So here you click on strangle, then you can play around with the strike price for the calls and puts. So they automatically choose something, but you can change it. You can change it and see the premium is $9. It was taken on the same day, right? So there the premium you are paying was $24 debit. Here you are paying only $9. So that way, you're reducing your premium paid, reducing your max loss, but still giving more flexibility. But break even point, if you remember, it is lower and higher. So that is the problem, because you have chosen different strike prices. It is just a tweak on the straddle strategy with different strike prices for calls and puts. So long straddle. So I think somebody mentioned about the probability of profit, right? So straddle is higher, but higher ROI potential because your investment is lower in strangle, right? And lower max loss. So that we talked about. Okay, so we have finished with the long strategy. Any questions or discussion points?
Hey Nari, Ajay over here. Quick question: how do you select the strikes for strangles? How do you adjust it? Not adjust it, like how much, what strike price you select?
Yeah, so this is
What?
more judgmental, right? So this is more judgmental. There is no strict formula per se. It is based on your judgment on how much the stock is going to move. Yeah, so that is.
Also interest.
There may be some people may be recommending, like Nanban or some other group. They may be recommending a standard strategy, but I have not seen anything. Bala, have you seen any guidelines on how to choose strike prices for a strangle?
I think it is like you said, it's a recommendation. See, actually on CNBC, that guy John Nigerian, he comes sometimes. He recommends strangles, and he tells you, "Hey, do this. This is what other people are doing." See,
Oh,
both
really?
strangle
Oh,
and
okay.
straddle are, in my view, volume related, technical related. Who is buying so many options? All those things. It's a market information based, technical analysis based buy and sell. So there will be some recommendations. There are probably groups out there who recommends strangles and straddles for you to buy to make money depending on a market condition. So for an everyday investor, it is very difficult for us to go and find a correct point of strangle and straddle. But if you want, for example, sometimes John Nigerian will say, I'm buying a strangle today on Amazon. He would say that. And then you could probably latch on to his strategy.
One more thing, what I like to do is there's a website called optionslams.com.
Ah, yes.
Optionslam, SLAM, optionslam.com. It tells you how much your stock is going to move based on the volatility. So check it out. I normally use that, and it tells you how much move is expected based on the earnings. So that's a good source of
Yes.
on the options.
Okay. No,
And it's
that's
free
good.
also. You don't have to pay for it.
So even think of
Yep, that's good.
things.
Yeah, good tip. Okay, so we have finished with long straddles and strangles. So we will move to short side, right? So here it is the same thing, other side, right? So here, so we are selling a call and we are selling a put at the same strike price and the same expiration date, and the maximum gain is premium paid, right? So you cannot get more than that. But the problem here is whenever you are short on something, right? So you always have a risk, either the stock shooting up too much. So here you have double risk. If it goes too much, or if it goes reduces too much, then you have a problem. So the greatest profit is the equal to the sum of the premiums of both puts and calls when they expire worthless, right? Which occurs when the strike price of both is equal to the stock price. Otherwise, it only, so the problem is only you should sell a short straddle only when you think that the stock or ETF or whatever, it doesn't move. That's not going to move much in the intervening period until the expiration date. Otherwise, it is a bit risky strategy. So outlook, right? So if you have an outlook saying, there is a small price movement, you are taking a chance of selling both a call or a put, then you are good. Or if you think that currently the market is too volatile and in the next 1 month the volatility is going to reduce quite a bit, right? So that is another way of saving your whatever money you got. So Greeks at the time of trade, again, delta is always 0 in all these strategies. And gamma is rate of change of delta is also negative, and vega is also negative because and you want it to be even lower than what it is right now. But theta works for you, right? Because the time value, right? Because you are short, you have sold a call, you have sold a put, and the sooner the expiration date comes without too much change in the stock price, then you benefit. So that's why theta is positive here.
That is probably a basic question. So all these are covered options, or you should have the stock with you to.
No, you don't need anything.
So it can be a naked.
Yeah, but you are taking a risk here, right? So you don't need to have the stock to do it, but without that, you are taking a risk. If it goes too much high, then you have to buy at that price and sell it for because you have sold a call. And other ways, it can go down too much also, and you are bound to buy it back at that price. So you don't need to have a stock for any of the strategies.
But I think you need to have in TD, you need to have that level 3 options trading.
Correct. So you need margins and you need permission. Like you have to know what you're doing, right? So this is advanced strategy. So XYZ stock is trading at 100, and you sell one February 100 call at 5 and sell one February put at 5, so you get a total of $10. So that is your maximum profit. Immediately made it, right? And but the problem is maximum loss, right? Maximum loss can be unlimited in both directions, and also it is subject to assignment if call or put in the money, right? So because it's American options, they can be exercised at any time. Break-even price, because the total of premium is $10, so it's $110 or $90, right? Maximum loss can be anything, I mean, much more than what you got. So that it is a risky strategy, but if you have other things, maybe like, you know, if you have the stock, it might help, but you don't have to have it. So this is the analysis of the trade. So delta is again 0, right? So here you are on short side, but gamma is also negative and theta is positive, because that is where time value works for you here, because you're in the short side. So here in TD Ameritrade, you click sell and click straddle. So it automatically populates here. You don't have to change anything. Again, it is $24. So it is the only difference. It is the bid and ask prices, right? So here you are selling 438 call and you are selling a 438 put, and your credit, right? So it is a credit transaction. So you immediately make money. But look at this max loss infinity, right? So that is so you made good money, because it's a at the money call and at the money put. You made good money, right? But you might have to do some analysis. What is the probability of profit and other things before doing this sort of transactions. Short strangle is very similar, except that the strike prices are different, right? So sell a higher strike call and a lower strike put. So you can do like different strike prices. So you are still hoping for small price movement, range bound stocks, and decrease in volatility. And the Greeks are almost the same as straddle, short straddle. So basically the example here, XYZ stock is trading at $100, right? You are selling one February 100 strangle for $4, 105 call and 95 put. Exactly the mirror image of the long strangle, right? Here you got $400. That is your maximum profit, and maximum loss is unlimited. It is very similar here. Oh. So here you are selling a strangle. So here you got some opportunity to adjust your strike price, and that is what Bala was talking about. These things can be driven by technical expectations or your own judgment, but you are taking a risk here, right? So because the risk is infinity. So just comparing the short straddle and strangle. So you have a higher probability of profit in a short strangle, because your width is wider, and lower maximum loss is short straddle, right? So here you can lose more money in short strangle. So this is just a summary of that. So let us get into a quiz here, right? So want some people, many people to answer these questions. A short strangle can benefit if the stock price moves up, moves down, stays the same, or all of the above. Read the question carefully and answer.
C.
Stays the same, right?
Any other thoughts? So everybody saying C?
Yes.
Yes.
So short strangle, right? So you are, it is not a straddle, right? So it is a strangle, and you have the as long as the premium you have collected, right? So if the stock, okay, this is the answer, right? So the answer is all of the above. So since a strangle is a directionally neutral strategy constructed with out of the money options, as long as the options stay out of the money at expiration, the trade will be profitable. So the question is, when can it be profitable? It can be profitable in all these conditions, right? So moves up or down as long as it stays within that range. I think that is the most important thing here, right? So as long as it stays within the range, you can, even if the stock moves up, you can still make money. So it is not that your strangle will make money only if the stock price exactly remains the same. It can move up or down. As long as it moves only little bit in both directions, then you can still make money. I think that is why they have chosen
Barry,
all
would you
of them.
mind going back to that graph? Maybe we can see that better.
Yeah, so even if the stock price moves, right, so you are still making a profit here, right? So yeah, so the maximum profit you have made, and the options will still be worthless. They will expire worthless as long as the price moves within this range. So only when it moves out of the range, then you are taking the risk, right? You are losing the money only when the stock moves high. So that is why the answer here is all of the above. Even if the stock moves up or down, you can still make money as long as it doesn't do too much.
Like poison, in moderation is good.
Right.
That's right.
Okay. Next question. A short strangle is typically categorized as a directionally bullish strategy or neutral strategy or a bearish trade.
Neutral.
Neutral.
Oh.
Okay. So I think everybody is clear on that. So it is a neutral strategy, right? So short strangles are constructed with a short put and a short call that oppose each other directionally, which creates a neutral range of profitability. I think everybody understood that. Great job. Short straddles and short strangles are both unlimited profit potential positions. True or false?
False.
Yeah, false. Unlimited.
It's unlimited loss, unlimited profit.
Right. So only long straddles and long strangles provide unlimited profit potential. Here, because you are selling both a call and a put, your profit potential is limited. Short straddles and strangles have a defined profit potential. Long strangles and straddles have unlimited profit potential, but low probability of profit. Okay. And a short strangle consists of what? A or B or C or D?
It's A. Right?
Short call and
Short
short put.
call.
A.
Yeah.
A? Anybody else for B or C? Okay. So a short strangle is constructed by selling an OTM call and OTM put in the same expiration cycle. Very good. Yeah, that's all I had for today. Any questions?
Yes. Which stock among